Good to see everybody again this month. We're going to hit what the data is telling us, seizing opportunities with appreciation. Of course, it's the season for Thanksgiving and Christmas and the holidays, and it's just, a good time to be appreciative of what you have, where you are in life, and I'm looking forward to that. So today we're going to talk about VIX. Volatility is not really showing fear yet. The market is a little bit choppy today, and this week hasn't gone much. But again, we're not seeing a lot of fear, and I'll show you how that's playing out. We're going to look at presidential cycles. My last time, I'm going to show you the first year of the presidential cycle and how that's playing out. Sometimes it worked, sometimes it didn't, but it's about context, not about how to trade. It's just give good insights. And then finally, we'll go through the current money stats and the situation there, and that's where we're going to go today. All right, let's start with the VIX. Here we go. VIX is not over 20. I think it's around 18 last I saw, maybe 18 and a half. Today is selling off a little bit. But, spikes above 20, this red line here, are really where you start to go, okay, something might be off. Right back here in April, it was way up here. There was a lot of fear in the market right there. You can see it down in here. But right now, we just don't have it. We get these little bouts of, something might be off and something to be concerned about, but it's just not there. So this is really pricing in fear in the S&P put options market. That's actually where this comes from. But they do a pretty good job of understanding when fear is expected. And right now, it's just not there. Even though we're getting a little bit, it's heightened, but it's not fearful. So I keep that in mind continually. But for now, I'm not too worried about that. Presidential cycle. Okay, so we expected a pretty strong October and a very strong November. So we had a decent October. It was a little bit up at the end. This pullback here actually happened in the first part of November. And it's expected to be pretty good and possibly a little rough towards the end. But historically, November is a really good time of year in the first year of a presidential cycle. And then December should actually be good on the second half as well. Like Santa Claus rally back into here is what we would likely expect. So, but once we get into next year, which I'll start showing every month starting next year, and probably starting next month actually, is the second year of a presidential cycle, which is historically very ugly. Certainly 2022 was second year of Biden, and you go back in history and you see there's typically a little bit more choppy, a little bit more iffy. So it was 22 back to 2018 was really a messy year, and then it sold off hard in the last quarter. That was a little bit different, something to be watching out for. But the second year tends to be interesting. So that's what we're going to keeping in mind next year. We're certainly going to think more about market neutral investing more and more. We run that currently, but we'll start implementing that into bigger pictures when bigger term trends, a lot of stuff that I'm going to show you here, starts to turn down, and then we'll be hedged and try to make the most of that because there's always ways to make money in environment. So, but for now, things are actually pretty good. I'm not too concerned. Let's look at the 6-month NYSE advanced declines above the 55. That's kind of one of our contexts that I like to look at. We went back above 3 days ago. Today, we're still actually above a little bit. So that's really not a lot of reason to be afraid of much. All right, once we break down here, it actually hung down here for a few days. That was getting interesting. We were starting to think we had to do something, but it really didn't go that far, right? Back here, it went further and then snapped back and went just kind of chopped and then it recovered. So that's fine. But we look at other factors that back that up, and it wasn't saying this was time to run for the hills just yet. But we're starting to see a little more shakiness in the market. We're certainly seeing tech not be the leader that it has been for the past 2 years. So far, the money flow is pretty good there. Our super short term actually gave a buy signal a couple days ago. I think that's actually 2 or 3 days ago. So money flow is actually good in the short term. I'm not too worried about that. This is like a micro version of the previous chart to help us go, okay, hey, we should trim a little bit here. We should buy a little bit here. That just helps us with context. So we did push down below this 200. It did kind of bounce back, and I'm curious to see how far it goes. If we can, I think we get through a couple of days of maybe just chopping, we should be okay for the rest of November. That's my guess, but I don't really know. Ultimately, the data tells us where to go, and that's how we make our decisions. Looking at the major market indexes, of course, big shock, Dow and developed markets are the strong one. They actually are still in an uptrend along with this Latin America. That's all looking pretty good. Now, over the negative side, we've got small cap. Small cap's just a mess. People keep, in the media talking about how you need to be in small cap and how it's going to diversify. I think that's just garbage insights. But NASDAQ, that's interesting because that's showing the tech weakness that I was talking about, and we're seeing some underlying issues. And I'll show that on the next one as well when we get into sectors, and that in China. So we have China, NASDAQ, small cap, all on the right side, negative. Short-term trend is okay, but I don't love where those are. But then, the Dow looks good. All of these look good. S&P's strong enough. It's not amazing. It's not bad. Mid cap is the bottom here. So yeah, generally speaking, the market's in a good spot. If we dive into the S&P sectors, because I think this gives such good insight into what the index is doing, so you can see where the strength is, where the weakness is. XLC, XLK, that's the tech. 2 tech versions. XLY, those are really all variations on tech, even though this is consumer discretionary and communications. All those have big tech names in them that you would know. Real estate. I think real estate has some potential here. We were looking, Chad and I, as a mean reversion plays. It looks like there could be a good bounce in that sector in the short term. That's something we're watching. And then over here, we have healthcare has the trend, as well as energy. I'm not a big fan of energy. Energy is really hard to trade, in my opinion. I like to go for the easy stuff, and that's just not one for me, but I do like to note it. It is actually, I believe, the smallest part of the S&P, so it's not super relevant for the trend. But the big ones are XLK, XLY. I think healthcare might be. Financials are a good one as well, but they're doing well. So we're very mixed on what's strong and what's not. But for the most part, we've got 6 sectors on the positive, 5 on the negative. It's still a positive ratio, so I'm not too concerned. And then if we look at the RRGs, all of them are setting up. This is my favorite thing if you follow me on Twitter. I love seeing a grouping in this red box of all the sectors, because what happens next is a very good jump up and to the right. That means we go to improving to leading versus T-bills, and that's a very strong push of the S&P 500. Now, the one thing that's cautious here is the XLK, which is the biggest part of the S&P, is it is heading down to the left into the lagging box. So maybe we have a couple of days, of choppiness, and today's certainly showing that. The market's a little bit messy, but if that pushes into here and we get all of these sectors pushing up at the same time, it's usually time for a very good rally. So that backs up the late November, December Santa Claus rally could very well play out based on these cycles. So I like that a lot. And then finally, we're going to look at the NYSE new lows. This has been very, very useful just to understand context of where we are. We did get some new lows below 100. That's where it becomes time to notice. In the April tariff tantrum, this went down to like negative 1,000. There's like 3,000, 3,500 issues on this. So it's a pretty broad way to look at it. But, these little dips, but 120, it's like, hey, cautious, but it snaps back. Okay, don't worry about it. We never went below 150. And that's another line for me. It's not written on this chart, but below that, or really above that number, is when, okay, there might be something wrong in the market underneath. But for now, we're just not seeing it. Even today, I think I believe we're at 58. So I don't know where that is. So this might be pushing down a little bit below this green line, but we're not seeing a sell-off like there's panic right now. So yeah, context is actually still pretty good. A pullback here is not going to be surprising. It's kind of in line with what we'd expect. The RG, the rotation, watching the ducks go around the pond suggests that. So that's where we are now.